Good afternoon, everybody, and welcome to our webinar this afternoon. We are going to be talking to students about inflation in just a few minutes. But before we do that, let me just give you a brief overview of our agenda. I'm going to give you just a quick background on the Making Sense project for those of you who are not familiar with it, share a few upcoming opportunities that we have in terms of professional development, and then turn things over to our guest presenter, Dr. Andrew Hill, joining us from the Federal Reserve Bank of Philadelphia this afternoon. At the end, I'll just do a quick wrap up with a few reminders and then send out the information for the evaluation and Act 48. If you'd like to take a moment and introduce yourself over in the chat, tell us where you're from, what you teach, that would be fantastic. For those of you who are new to the Making Sense project, this is a partnership between the Pennsylvania Department of Education and Penn State University, and part of an overall program focused on supporting economic and personal finance education for primarily K-12 students across the Commonwealth. Our webinars tend to focus on one or more of these sort of three pillars, if you will: enhancing content knowledge, which we'll definitely be doing today when we talk about inflation, highlighting some financial literacy resources, and then sharing professional information. And so I'm guessing we'll probably actually do a little bit of all three of those on this session this afternoon. We have a couple of other professional development opportunities right now that are available. We are in the midst of a 3-week virtual workshop. So if you are interested in joining us, it is not too late. This is a very flexible, it's about the most flexible PD I've ever done or offered. It's built entirely in Canvas and focuses on the 6 big ideas that we have in our personal finance instructional framework. So you are able to go in and hop in and out on your own time. The way this works is that for each assignment, and those assignments are from that choice board. So for example, sharing a favorite lesson or a topic that you find particularly challenging, or a digital resource, what have you. For each of those that you share and engage with us in, for each of those 6 big ideas, you receive 15 points, which is equivalent to 15 minutes, or a quarter of an hour. So we are giving or granting our Act 48 credit with a minimum of 3 hours and a maximum of 10. So we have people who have achieved at both levels already, which is fantastic. So, hop in there and get started and join in to the conversation. We have a nice variety of both newer and more experienced educators in there with us. So would love to have you join us. And there's a QR code there to register, as well as the link. We do have 2 more upcoming webinars next week on sort of the status of personal finance in Pennsylvania, and as well as May 9th, we'll be talking about the documentary Get Smart with Money from Netflix. Last but not least, we have 2 book studies coming up: Broke Millennial Talks Money and The Psychology of Money, one running basically for the month of May and the other one for the month of June. So those, again, will take place in Canvas like we have done with our previous book studies. These have the ability to be able to follow a little bit more of a structured format. So in these, we are going to be following a weekly schedule of readings and discussions. However, same with our other programs, you can join asynchronously, so no reason to be on at a specific time. We just ask that folks try and keep up with the readings so that we're all talking about the same things at the same time. And one more thing, if you would care to join us, we also have a Facebook group. So again, one more way to engage. So it's my pleasure this afternoon to welcome Dr. Andrew Hill. Andrew is the guru of economic and personal finance education in Pennsylvania, housed at the Federal Reserve Bank of Philadelphia. And Andrew, let me just stop sharing my screen so that you can share yours. But Andrew has been a longtime colleague in financial education with me individually, and has been a fantastic presenter for us before. on a whole host of different topics. So it is my pleasure to welcome Andrew with us today to talk about inflation and how do we address this, what might be considered a rather complex and ever-changing topic with students. So thanks you so much for joining us, Andrew. I'm going to turn everything over to you. I can see your slides, so we should be all good.
All right, sounds great. Thank you so much for having me, Hillary. I'm really excited to have an opportunity to chat with everybody about how we teach inflation to kids. Obviously, this has been a really important topic over the last couple of years and something that we've been working on at the Fed. And of course, we've always been engaged in teaching kids about price stability. So just to give the standard disclaimer, which is that the views I'm going to give today are my own and not necessarily those of the Federal Reserve Bank of Philadelphia or those of the Federal Reserve System. So just to emphasize that these are not my employer's views, but are my own as part of my overall work in economic education. So one of the things I think really one has to always make sure that they do when they're teaching students about inflation is to really level set about what we're talking about with inflation. And lots of times you'll hear in the media, you'll hear various times when people don't understand exactly what we're talking about when we're talking about inflation. Inflation is an increase in the overall level of prices across the entire economy. All right, so really important that we're talking about the overall level of prices. So it's not the level, it's not the prices of a specific market or a specific good, all right? So it's also important to make sure that people understand what deflation is. And so right now we have a period where inflation's running higher than the Federal Open Market Committee's target. It's more than we want it to be. And so sometimes it's hard to realize that at times, or there could be fears at different parts of the business cycle about the idea of deflation. So getting kids to understand what deflation is really important. Deflation is a decrease in the overall level of prices across the entire economy. So the direct opposite of inflation. So this is where prices are falling across the entire economy. Our last major incident of deflation in the United States was during the Great Depression. So one of the real challenges with deflation is that people wait to spend because they know that prices are falling across the economy. This means that inventories that businesses have grow, so their inventories are increasing. With their inventories increasing, they don't find a reason to produce more of whatever the good is, and so they wind up then laying people off, and we see then a spiral where then consumer incomes fall. They continue to wait to spend. So it's really important to make sure when you're teaching about inflation that you also get kids to understand that we don't want to see prices falling across the economy. And then there's a third concept, which I don't have a slide for, but it's called disinflation. Disinflation is what we've seen starting here now, where we still have inflation, but that inflation is a smaller percentage gain every year. So we're seeing inflation get smaller. We're still seeing prices growing. So we're not in a deflationary situation, but we're seeing disinflation where we're actually bringing the inflation rate down. Both inflation and deflation can be a problem. So a little bit of inflation, that's something that we'd like to see in the economy. It's commensurate with a healthy economy. When we have too much inflation like we have today, that creates significant challenges for businesses and individuals. So again, really important to emphasize that inflation is the change in the overall price level. So I have a market basket there, which includes down on the bottom things like gasoline and education costs, prices of cars. So when we're thinking about inflation, it's about prices across the entire economy, the overall price level. Inflation is not a change in a specific price for a specific good. So sometimes you'll hear people erroneously say, hey, there's inflation in gas markets. Prices might be going up for gasoline, but that doesn't necessarily mean that we have inflation across the entire economy. That's just increasing prices in a specific market. Thinking about inflation, we really have to think about the two different types of causes. One of the long run causes, and we spend a lot of time at the Federal Reserve talking about the long run causes of inflation and ensuring that we don't have that happening. And in order to get long-run inflation, you need to have too much money chasing too few goods. This was the experience of the United States in the late 1970s and early 1980s, where the Federal Reserve was growing the money supply too quickly for the amount of goods that were being produced in the economy. So we know from Milton Friedman, famous economist, that inflation is everywhere, always and everywhere, a monetary phenomenon. So in the long run, it is a monetary phenomenon. And the Federal Reserve works hard to ensure that we're not growing the supply of money, that the growth rate of the supply of money is not faster than the overall growth in the long run of the amount of goods that we're producing. But short run causes can be things like supply shocks, and we're going to talk a minute about what I mean by supply shock, excess demand in the economy, and then also expectations. So if consumers expect that inflation is going to be happening in the future, they will then build that into their decision making. So short run versus long run causes. Much of what we've been seeing over the last year, 2 years has been driven by the short run causes, certainly not on the long run causes. So one of the key ways that we measure inflation in the United States, the one that you hear about the most in the news, is the Consumer Price Index. So this is a cost of living index. It seeks to measure what consumers actually pay. It's collected by the Bureau of Labor Statistics, and they're looking at a market basket of 80,000+ prices, and they're looking at those and bringing those together in a periodic monthly basis in order to get an estimate of what inflation is in the United States. It looks at what we would expect for typical urban consumers, but urban as defined by the Bureau of Labor Statistics actually includes over 90% of the US population. And so the goal here using this method is to look at prices and track them over time. They do have an update schedule where they update what that basket, that collection of different prices are that they're looking for. But this is the main number that consumers hear about the most on the news. The other key thing to think about is the difference between what we call headline versus core. So in the core, and this sometimes frustrates folks, in the core, what we're doing is we're taking out the food and energy prices. And you say, well, hey, that's an important part of what consumers buy each month, which is food and energy, gasoline, home heating oil, etc. But what we also know about food and energy prices is that they're highly volatile, and they're driven oftentimes in the short run by short run factors like we just talked about. And so therefore, in order to try to get a better understanding of what the overall trend of prices in the economy are, we will take out the food and energy and then get a core percentage change. So this is from Bureau of Labor Statistics, their recent report, looking at all items and then also looking at all items less food and looking at the percentage change. So coming all the way at the far right side of the graph, we have the March 2023 numbers. On the left, we have the March 22 numbers. And you'll see that we have seen a significant decrease in inflation in the United States, with the all items being at a peak over 9% on an annualized basis in June of last year, and now down to 5%. It's still not good enough. The Fed is still seeking to bring that down, and they said that during their last release after their most recent meeting. But nonetheless, we are seeing this disinflation as the inflation rate is falling. So we're seeing some of that. It's still not enough. One of the things that you'll see here also is that the all items less food and energy, that core CPI number, has tended to be somewhere in the range around the 6% level. It was higher than that in September of last year, and we're now seeing it below 6%. But this gives you a sense of the fact that once you take the food and energy out, you get a much more stable line, and we still have much work to do in order to get to the level that the FOMC seeks to target. There's another measure of inflation, which is the measure that the Federal Open Market Committee prefers, and this is the Personal Consumption Expenditures, or PCE price index. So this captures changes in the prices for the personal consumption component of GDP. So if you remember, with GDP is C plus I plus G plus net exports, it's the C portion of that equation, and looking at the changes in the prices for that consumption portion of GDP and looking at that over time. The Federal Open Market Committee, the Federal Reserve's policymaking body, has determined that and stated that they have an explicit target of 2% for inflation, and that is the PCE index that they're using. So we're significantly above that still, and working to get below that. So talking a little bit about inflation worldwide. Now these images, which come from Statista, are a little bit old. They were from late last year. But one of the points that I wanted to make with this is that inflation has not just been a US phenomenon coming out of the pandemic. Inflation has been a significant global concern, and it was a significant global concern last year. And different countries around the world have experienced high levels, or higher than what we would hope, levels of inflation across the world. So certain countries are having significantly higher than the US. There are reasons for that. A few countries have less inflation than the US, but for the most part, this has been a global phenomenon, and it's tied in large part to factors coming out of the pandemic. And so we'll talk a little bit about some of those. So I promise that this is the only supply and demand graph, or the only two supply and demand graphs in the entire presentation. If you remember, and you've taken principles of macroeconomics, you may have seen this aggregate demand and aggregate supply framework. And the reason I show this is just to understand that if we have a reduction in aggregate supply, so that is supply across the entire economy, if we summed up supply across the entire economy, and we reduce supply, that would drive up the price level. Price level, again, remember, is inflation. So if you have an increasing price level, then you have inflation. So reducing aggregate supply in an economy, all other things held equal, is going to drive up inflation. Also, if you increase aggregate demand in the economy, all other things held equal. So this is the graph on the right. So going from the gray line to the red line, if you increase aggregate demand in the economy, you're again going to be fueling inflation, driving up the price level. So with that in mind, certainly we seek to be in the center of this seesaw. So on the right-hand side, with inflation, you would have GDP growth, and we are seeing significant GDP growth in the United States. We're seeing low unemployment. So this is an economy that, if you will, is overheating, or is running strong, running very, very hot. And that's what we're seeing with inflation. At the other end of the spectrum, on the far left of the seesaw, you see low inflation, God forbid deflation. By the way, deflation is very hard to get out of. Or harder to get out of than we would like. And we certainly want to avoid deflation at all costs. GDP decreases, so you would have recession, and high unemployment. And the sweet spot is the spot that the Federal Open Market Committee has been charged by Congress to achieve, which is price stability, that is to say, not much inflation, maximum sustainable economic growth, so that is that the economy is growing as fast as possible without fueling inflation, and that we would have low unemployment. So I always think back to something that was in actually a video product that I'll talk a little bit about in a few minutes here. But we interviewed Ben Bernanke when he was chairman of the Federal Reserve. And he said, monetary policy making can be very challenging. I think about it as a quarterback who throws the ball not directly at the running receiver, but ahead of the receiver. In the same way, when we make monetary policy, we don't want to just think about where the economy is today, but where we think it's going to be when those policies begin to have their full influence. So monetary policy making, I think folks really sometimes underestimate the amount of art that goes into this process. So while there's a lot of science that goes into monetary policy making and trying to achieve the monetary policy goals, it also requires quite a bit of anticipation and timing in order to get it right. And we don't admittedly always get it exactly right, but folks at the Federal Reserve work hard to try their best to get it to the level that it needs to be. So again, quite challenging. And we've had a challenging period of time. Some of those factors that influenced aggregate demand, aggregate supply, certainly on the aggregate demand side, consumers saved a lot during the pandemic. And many of us, and myself included, we weren't traveling, we weren't perhaps spending on some of the things that we might otherwise would, like dinners out, things like that. And so a lot of savings was drawn up. People are now ready to travel. They're ready to be able to live their lives again, if you will. And so that has created some pent up demand, and that has made and forced the aggregate demand side up. So driving inflation from the fact that people now have the capacity and the willingness and the desire to demand more. And we're certainly seeing that in travel prices and travel markets. But we also, on the other side, had significant supply chain woes, problems on the supply chain. So certainly we're aware of the fact that China, where we get many of our consumer goods, particularly those of relatively low value, they had significant COVID-19 restrictions that had an effect then on affecting supply chain. I put this here, Krynic, those of you who are stitchers, I'm a stitcher, and we use these metallic braids. They had significant problems getting raw materials. They had some equipment challenges, but at the same time, this was one of the few places where people were doing more and more crafts. And so you see in very many different areas, challenges trying to meet consumer demand because of supply chain issues. And these were significant in lots of different areas. We also saw and have seen and are continuing to see significant war in Ukraine. This has affected a number of commodity markets. It has affected grain prices, and particularly early on in the war, but it continues to be there as well. And then also certainly significant changes in crude oil and natural gas markets, particularly in Europe, but other parts of the world as well. And we've seen those pressures that have been there as well. So we had a number of whammies. Another one that hit the US was the avian flu. About 10% of the laying population of hens in the United States was affected. This is an old graph now, but we saw significant run up of egg prices, and likely you noticed this yourself. If you're like me, I reduced the number of eggs that I was actually consuming as a result of this. But one thing that is true is that we've started to see prices begin to fall. So down by about 11% here. And so the graph on the right, and I'm sorry that's a little bit fuzzy. I had a challenge trying to find one that was higher resolution, but this is actually the 3-year average, which is the blue tick mark line. And this is the months across the year. The green ticked line is 2022 prices. So you saw that they were driven significantly higher, particularly by the end of the year. And the red line is where we have been so far in 2023. We've seen those prices overall begin to fall. And so hopefully there's some movement happening there in terms of bringing prices down in that market. But the important part is that there's been a number of shocks in these various industries, and they all come together then to create an overall price level that's significantly higher. I also should, this is again just slightly old, but this is about the 2022 forecast for macroeconomic risk in the world. And one of the reasons I point this out is that we sometimes don't think globally, or maybe individual students don't think globally, but we actually have been in a position where we likely are significantly better off than much of the rest of the world, particularly those places that have been affected by food insecurity related to Ukraine, a number of other significant crises around the world. One of the things to think about, and I think that this is one of the challenges in teaching this concepts, particularly in the modern world, is that it takes a considerable amount of time for economies to make change. There's not, it's not instantaneously. I think prices often will go up very quickly, but there tends to be price stickiness on the way down. Some of this has to do with potentially profit taking in various industries, as it takes a little bit of time for there to be a realization of competition within industries. But I think also just issues like menu costs. So this is the point where, for instance, if you're at a restaurant and the menu has to be printed, oftentimes the prices will stay up longer than they otherwise would have. It's rare, I think, sometimes to really see menu prices begin to fall until you have recession. Hopefully that won't be the case. Occasionally you see folks making changes to menu prices as the input costs go down. My favorite restaurant, we had significant challenges during the pandemic getting crab, particularly from the Gulf Coast and some other areas, as well as crab meat coming from Asia. So for a while, crab cakes were $40. The owner actually did drop the price on the menu, which was quite exciting because you're always worried about whether they will just stay up forever. But price stickiness does mean that prices sometimes are a little bit hard to see them actually fall across the economy because of the stickiness upwards. The Federal Open Market Committee, in their 2023 March meeting, after that meeting, they came out with a set of projections. And so this is the personal consumption expenditures inflation. That's their favorite measure of inflation. So you see, and by the way, these are annualized numbers. So you see that for 2021, 2022, it was running well above 5%. Remember that the FOMC's target, where they want to see PCE inflation, is at 2%. And so then they make a set of projections. So there are 19 members of the Federal Open Market Committee group. So these are the 12 Reserve Bank presidents, as well as the 7 governors of the Federal Reserve System. And so what they do is they take each of those individuals' projections and they create an average number. That's the number you see that's in red there. So you'll see that their expectation for 2023 overall inflation from the PCE on average for the whole year would be somewhere north of 3%, but then heading down towards the longer run expectation, and that they're seeing that as being here by 2025 of being back at 2%. The bottom is the core, again, not removing the food and energy prices. So it's valuable, I think, sometimes to show your students that there's an expectation this is going to come down, but things don't happen instantaneously in our economy for the most part, and it takes time for monetary policy to have its full effects. I think it's also important to note, and Treasury Secretary Yellen had talked about this weekend in media interviews, but certainly Chairman Powell has talked this as well. We're seeking to have what's known as a soft landing so that we can bring inflation down without causing recession, without causing high increases in unemployment. And so that is the goal: get back to the target without having adverse effects on other aspects of the economy. The good thing is, I think a lot of the supply side issues are starting to get themselves worked out. I just saw this morning that the GDP numbers coming out of China, that the Chinese economy seems to be coming back quite well after the pandemic. And so getting supply chain issues resolved is going to be a helpful part of that. I want to spend a little time talking about the resources that the Federal Reserve banks have for helping you to teach about inflation. The nice thing is that over the years, we've produced quite a number of video products, and there's a bunch of different ones in different veins that you can try out depending on what style you will like. So what I've done is I've created a live binder. This is our favorite place for repository for putting materials together when we do professional development programs. And I should mention, we have always look at what's coming up from our professional development offerings. We have a program here in Philadelphia at the Reserve Bank next Tuesday night. Registration closes tonight for that. So if you're interested in that, drop me an email, andrewhill@phil.frb.org. But whenever we do a professional development program, whether it be in person or online, I like to put the resources that I talk about in the live binder. So the URL for the live binder is there at the bottom of the screen. You have to use the access key in order to be able to unlock the binder. But once you do, the resources that I'm about to talk about, they're linked into that live binder so that you can access them easily. I want to talk a little bit about our old friend, Benjamin Franklin, our Philadelphian, because one of the really interesting things and a really interesting connection between history and teaching about inflation really involves Benjamin Franklin. So we produced at the 300th anniversary of Franklin's birth here in Philadelphia, there were lots of celebrations. One of the things that we had here at the Philadelphia Fed was a talk by Farley Grubb, who's a economic historian at the University of Delaware, and he presented on Benjamin Franklin and a birth of a paper money economy. So one of the things that's interesting about Franklin, and I don't have the actual publication that he wrote linked in here, but in 1729, he published a pamphlet. This was actually the first of his pamphlets that he published after he bought the Pennsylvania Gazette Press here in Philadelphia. And in that publication, because we know about we know about Franklin as a scientist, as a diplomat, as a printer. But one of the things we also are aware of the fact that he also was heavily involved early on in his career, in particular with printing paper notes for Pennsylvania, but also more prominently for New Jersey, the colony of New Jersey. But he had a lot of observations that are very, very important to us about paper money and the use of paper money. So one of the things that he observed when he first came to Philadelphia in 1723 was that if an economy, if the colonial economy didn't have enough money circulating, that economic activity would really drop off, that people would stop coming to the colony, people might leave the colony. So if you don't have enough money in circulation, that really causes economic activity to drop off. So while in the colonial economy, they were much more likely to use barter and the use of credit, because they did have the ability to, borrow on credit if you could get somebody to lend to you. But borrowing and using credit in those days was difficult. And so if there wasn't enough money in circulation, the economy would really go into a slump. So this is really an observation that's very comparable to what we know about deflation today. He also observed other colonies that printed too much paper money that wasn't backed by anything. And the result then was that you would see significant inflation. So he talked about inflation, what happens if your currency is not well backed, if you have too much money chasing too few goods, what that does to the overall price level. So the cool thing is that Franklin in the 1720s was observing things that were happening to the price level and wrote about them. So we have this great publication, and then I produced a lesson that goes along with it. So in that lesson, there's a couple of different activities. One of those activities is the inflation auction. So one of the things that we do in order to illustrate to students that long run effect, that if you grow the money supply too much in the long run, that it grows too fast, that you'll get inflation. So if you grow the money supply faster than the amount of goods that are being produced in the economy, and you do that over the long run, what happens to the price level? We use an inflation auction to do that, and I described it in the lesson. The lesson's on our website, but it's also linked into the live binder. I also developed a little activity, and you put the students into groups of 10. You give them these trading direction cards as well as these commodity cards, and they trade the cards. They have to do it with money. They can't barter, and you have to really watch them to make sure that they're not bartering. And you have these little coin cards. So you do 2 rounds of this activity. In the first round, you give them all 8 of these coin cards for the group of 10 students. So you have to, by the way, you have to make sure that you do this in groups of 10. You can't give out 22 cards because that has to be a complete set in order to work. So what you do is you put them in groups of 10. If you have extra students, you have them pair up. And they get 1 set of cards between 2 people, but you have to do it in groups of 10. Anyway, they have plenty of money in order to do this relatively quickly. Then what you do is you collect up the cards. There's little index numbers on the bottoms of the cards on the lower right, so that you can put them back together, use paper clips. This is all described in the lesson. You then have them do the second round, but this time for every 10 students, you only give them 2 coin cards. So there's not nearly as much money in circulation. They have to use the money. They can't barter. When you finished your transaction, you take the money back to your desk. So that means that money will go home and be put under a mattress or whatever the case may be in the activity. And this results then in the students who are left there without as much money in circulation, having difficulty being able to make the trades happen. They'll want to try to barter. You have to watch about that. But what it tries to illustrate is if you don't have enough money in the economy, if you don't grow the money supply fast enough, that's a corollary description of that, then economic activity is going to drop off. It's going to be more difficult to carry out trades in the economy. I wrote as part of that lesson also a reader's guide so that you can send the publication home with the students. And those publications are all available from the Philadelphia Fed. You can order them on our website in free class sets. The Federal Reserve Bank of Philadelphia website, just look for our order blank where you can order class sets of the Benjamin Franklin publication. It's also available as a PDF, which is on our website. And I've also linked it into the live binder if you want to use the PDF. Many reserve banks have produced, as I said, a number of different videos. And what I want to show you is the one that comes from the Atlanta Fed now. This is the Atlanta Fed Explains video on inflation, one of my favorites. These are on YouTube, so they're easily embeddable into if you have online learning management system, whatever learning management system you're using. They're also available in the Econ Lowdown portal that is been developed by the St. Louis Fed. So many of us contribute materials into that. And the nice thing about Econ Lowdown is that you can get an account for yourself for free of charge. You can then create a class roster in there, and you can assign then to the students the videos, and there's video Q&A that goes along with that. There's lots of other types of resources that are in there, but the nice thing about Econ Lowdown is you're able to assign materials to the students. If you're using Canvas as your learning management at your school, there's a way to actually connect Econ Lowdown to Canvas. But let's take a look at this video while we have a second here, and give a chance to look at this. Gives you a lot of the basics about inflation, and I think in a fun way for students.
Prices go up. Today, an ice cream cone costs $2. 50 years ago, that same ice cream cone would have cost 50 cents. What's the difference? Is it tastier? Bigger? No, it's the same. So why does it cost more today? Inflation. When the price level of goods and services goes up over a period of time, we call that inflation. Inflation makes every dollar you own buy a smaller percentage of a product or service, like a hot dog. In the past, $1 would buy a hot dog. Today, $1 would only buy you half. Same thing for a car or a haircut. Prices can change for many reasons. Inflation is a unique type of price change. To understand inflation, we first need to understand something called price level. Price level is the average of the current price of everything sold in our economy over time. Hot dogs, haircuts, umbrellas, automobiles, essentially anything that's bought or sold with dollars. Economists keep an eye on the price level because they want the purchasing power of your money to stay stable from year to year. If the price level begins to rise too quickly, central banks, like the Federal Reserve, will try to adjust monetary policy in order to slow this advance in prices. Okay, so an increase in prices is always due to inflation, right? Wrong. Let's take a closer look. Imagine an island where the only thing to buy is balloons. You've got to use dollars to buy them. Lucky for you, there are 2 balloons to buy and $2 in circulation. So, what's the price of the balloons? $1 each. And if a balloon pops, what's the new price? That price increase isn't an example of inflation. It's a different kind of price change. A change in the cost of living. What's the difference? Well, let's look at another scenario on the same island. Once again, we have 2 balloons and $2. But this time, we'll add a central banker who can print money. Changing the amount of money there is to buy balloons will change the price of balloons. So if the central bank decides to print and add another $2, what does that do to the price of balloons? It doubles to $2 each. That is inflation. So where does the Federal Reserve come in? For one thing, because central banks, like the Federal Reserve, have control over the money circulating in the economy, they can set the price level, the dollar value of things at whatever level they think is best. But in the real world, the Federal Reserve's role isn't that straightforward. If prices are going up because there's a shortage in cotton, or oil, or even balloons, the Federal Reserve's ability to do anything is limited because it doesn't produce oil or cotton or balloons. It only produces dollars. On the other hand, if prices are going up because there are too many dollars in the system, the Federal Reserve can do something about that. It can adjust its monetary policies to keep the overall price level steady. That is, from rising or falling over time. See, inflation is like, well, it's like tire pressure. When tire pressure gets too low, there's not enough air to cushion the ride. When tire pressure gets too high, you can have a blowout. Either way, if the pressure isn't steady at the proper level, it makes for a bumpy ride. So, over time, the right amount of inflation, like steady tire pressure, lets you go the distance and gives the economy a smoother trip. The Federal Reserve keeps an eye on inflation so you can keep your eyes on the road. There's still a lot to learn, so check out the resources on our website at frbatlanta.org for a more in-depth look at inflation and other topics.
So one of the key things here, I think also is to emphasize that we've been in this period where the supply of those goods that people demand has been the thing that's been significantly affected, as well as just the fact that consumers' demand was sort of pent up during the pandemic and then unleashed after the pandemic. So together, these things have created significant shocks to the system that have resulted then in the price level being higher. But we also understand the things that we need to do in the longer run to bring inflation down. So I also want to mention the Federal Reserve and You project. This is a project I worked on now quite a number of years ago, but a lot of the videos that are in here, there's 70 total segments, and they range from things about what does the Federal Reserve do, the history of central banking in the United States, but there's a whole section on money and banking, and there's some great videos in there, including one that's on inflation. I'm going to show you this one because one of the things that this does is I do a little stylized version of the inflation auction. Now, I'm only auctioning off one good here, but it gives you a chance to see how that works in terms of auctioning off items, but also gives them just some other overview aspects of inflation. So this is available on the Philadelphia Fed YouTube channel. I've also linked it into the Live Binder.
You can inflate a basketball with air, but in economics, inflation means a rise in the general price level of all the goods and services produced and sold in an economy. One of the causes of inflation can be too much spending chasing too few goods. In other words, the total demand for goods and services in the whole economy is greater than what the available resources can supply. Let's see how that works.
And we have this great car that we're auctioning off today.
These students are bidding on a car. Let's assume that car represents all the goods and services produced in the economy during the year. The bidders have different amounts to spend, up to a maximum of $10,000.
So let's start out with a first bid of $1,000. Right there, I got 1,000. How about 3,000? 3,000. How about 5,000? 5,000. 7,000?
7,000.
8,000 right here, 8,000.
8,500. 8,500, right? 8,500 with this guy going once, going twice.
Aha! This lucky bidder gets the car for $8,500. But what happens when the money supply is increased and the same people bid on a second car the next year? Same model, but the maximum any bidder has now is $25,000.
You guys have the dough, you know, you got it going on. Who give me 5,000? 5,000?
When the maximum possible bid is raised to $25,000, the car goes for
21,000.
$21,000. That's 147% inflation. Now remember, we assumed that the car represented all the goods and services produced in the economy in each year. So, the inflation was caused by an excessive increase in the money supply, coupled with no change in the amount of goods and services produced in the economy in each year. Another cause of inflation is called an inflation shock. In 1973, an oil embargo caused a dramatic rise in oil prices. Because so much of the economy depends on products made from oil, the result was higher inflation throughout the economy. There are several things that can lead to inflation in the short run, but long-run, sustained inflation is caused by excessive growth in the money supply. In the 1970s, inflation shocks, such as the dramatic rise in oil prices, were coupled with excess growth in the money supply. Together, the inflation shocks and the overly accommodative monetary policy fueled inflation throughout the decade. This is why price stability is so important to the Federal Reserve, which can control the growth of the money supply in the United States.
So I think a lot of folks
You can inflate-
know and understand the aspect of the too much money chasing too few goods long run cause of inflation. They miss the part about the inflation shocks. And so understanding that you can have shocks like the oil crisis, certainly the pandemic has been a significant inflationary shock. Things like the war in Ukraine is a shock, but understanding that as well is important. The Fed works to combat both of those potential problems, but it's important to understand that it's not always just that the money supply is growing too fast, that these inflation shocks can have significant impact in what the inflation level is in the short run. I'm not going to belabor the point of showing you another video, but I want to point out that there's another one that's here. If you want to take a look at it, you can check it out in the live binder. I've linked it. This one was produced by the St. Louis Fed as part of the Economic Lowdown series on inflation. And it includes animation, but also my colleague Scott Walla does some teaching as part of that video as well. So another great resource to check out. I want to also mention to you a product that's been product sounds like it has a price. These are actually available free of charge. You can order them from the Atlanta Fed. They have a whole series of these infographics. So these are a poster. They're a long poster, which is really hard to show in a slide. I've chopped it up here to put into this slide. But this is, you can order for your classroom. And there's also a lesson that goes along with it. So this is a great infographic for your classroom. It gives the key points of calculating the inflation rate, the difference between CPI and PCE, excuse me, core versus headline, and gives definitions of things like price stability and what is inflation and what happens if you have unanticipated inflation, who benefits, borrowers or lenders, et cetera. So a great resource has been extremely popular, and there's a whole series of these infographics. Again, go out to the Atlanta Fed's website and check out the infographics that they have in a number of different topic areas. They've been very popular, and they're great resources to order for your classroom. My colleague, Ava Johnson at the St. Louis Fed, if you teach elementary school or you know someone who does, she created a grades 3-5 CPI market basket. So this is a great lesson that teaches students about inflation, talks about the consumer price index for little kids, and a great resource. I've linked this into the live binder. It's also available on the St. Louis Fed's website as well. So then you can always find that as well. So that's for the younger students. I'll emphasize to you that I'm only showing you a small portion of the total resources that are available from the Federal Reserve. If you have a chance, go out to federalreserveeducation.org. That's our portal site where we try to get everything that we can in there for all the different reserve banks. It's searchable. It's searchable by standards and grade level, and all the different types of resources that are available from all 12 reserve banks plus the Board of Governors are all in that site. So check out federalreserveeducation.org when you have a chance as well. So I'm going to leave it there and see if there's any questions that are out there, or if Hillary has anything else for me here tonight.
Andrew, thank you. I appreciate it. This has been great. I'm going to share my screen again for a second. Hang on. So thank you. Get everything switched back over between screens here. Always fun. But thank you so much. I didn't see any questions, but I did share a couple of those links out, including the link to the live binder with that access key out in the chat. So hopefully everybody was able to grab those resources, and we'll go and dive into those a bit more. I did have two others that I wanted to share that are unaffiliated with the Federal Reserve, but on the same topic. So these are two from one of my favorite sources from PBS called 2 Cents. Their series, if you're familiar with it, it just has a sort of a different take on similar topics. This one is quite recent. This is from February of this year, about 8-minute long video on if you thought this inflation was bad, and it goes back sort of over the history of of prices and interest rates and all sorts of different components that are addressed in that, sort of to give things and put things into a bit more of a historical perspective for individuals and for students. And then this other one on why are prices going up. This one is a little over a year old, but also a very good video as well that explains some of those basics. A question, Andrew, for that came in the chat here, that maybe you can rejoin us for just a second. How much has quantitative easing been a factor on our current inflation?
Well, I think that, one of the things that we were doing quantitative easing during the period that preceded the pandemic, and it was, coming out of the financial crisis of 2007, 2009, it took a considerable amount of time to get the economy to recover from that downturn. So there was a lot of work that was being done over that period after that in terms of trying to get the economy spurred enough. So one of the real concerns when you're in a recessionary period is to try to make sure you don't wind up having prices falling across the economy, a deflationary period. So there was a lot of quantitative easing that was done in that period in order to try to we had very low levels of inflation, and we were also seeing higher than hoped for levels of unemployment. We had begun to tighten after the financial crisis. We had begun to see federal funds rate increase. We were seeing the economy growing, and then we went into the pandemic. Admittedly, the pandemic was very scary. We had a lot of uncertainty as to how long it was going to last for. It was global. We saw these significant shocks that were happening. And there was a concern, as you know, across the economy that with so many people out of work, what was going to happen to people's livelihoods. So both in terms of fiscal policy, which the Federal Reserve is not responsible for, this is government spending programs, as well as the Fed carrying out various programs to bring interest rates down in order to spur economic growth coming out of or during the pandemic. This was very important. What's difficult, and this is why I share the quote from Chairman Bernanke, is timing, right? So there was a lot of uncertainty about when the economy was going to begin to start again. And there was a lot of uncertainty as to what was going to happen in other countries like China. So I think that arguably with 2020 hindsight, and it's always easy to be the Monday morning quarterback, the accommodation perhaps could have come off sooner in order to try to alleviate some pressures. But admittedly, a large portion of what we're seeing has been supply chain driven. Now, what happens is then you start to build in levels of inflation into the economy, and sometimes that can become a self-foreseen prophecy. But one of the things I didn't share today were the inflationary expectations numbers. And if you look at people's expectations for 5 years down the road, they don't expect there to be high levels of inflation. So much of this seems to be a lot of recovery from coming out of the recession, coming out of the pandemic. And I think, admittedly, we're working at this point to tighten, and everyone expects that the sort of neutral level of the federal funds rate will be much higher than it was before. But we were facing in the period before this that we did have a lot of space between the lower bound in terms of inflation. So if you did run into a recession, you could be in a position where you become concerned about deflation. So I think that certainly your point is well taken, that accommodation probably was, now that we know with 2020 hindsight, was probably in place for too long. But at the time, we wanted to ensure that we didn't take the punch bowl away too fast, if you will, because that could have had a negative impact on the overall economy. And we could be talking about recession today rather than inflation.
So Andrew, I'll follow up with a sort of a different take on a line of questioning, but a key component of all of this is the impact of the federal funds rate on the interest rate that consumers are going to be charged, for example, for a mortgage or for a car loan or that they can expect to earn when saving money. You know, we sort of debate as educators, right, what we want to look at in terms of, say, for example, when we're projecting the growth, the compound interest of savings and investments. What are your thoughts on sort of where teachers should land? You know, we've been in such a low, say, for example, mortgage interest rate, environment for so long. You know, a lot of people haven't seen rates, where we are, certainly not from decades in the past. Do you have any thoughts sort of on where educators land in terms of, being sort of, grounded in the present and in reality? But, when we try and give students a look ahead to the future, or thinking about, what the total cost of credit or what have you might be, sort of thoughts on just sort of like, how to balance those two, and or, sort of realistic numbers to think about, or, just ways to sort of balance that out as a factor that is never a foregone conclusion, right? And we don't want to get things. I have this fear that we when we rerun, mortgage calculators, for example, with students, all with interest rates of about the same range, that we're sort of locking in this idea of students that this is about the cost of credit, right? And we know that that's not true. It fluctuates tremendously over time. We've just been in this very long period of low interest rates. Any thoughts on that?
So I think one thing that you do bring out is an important point, which I think that sometimes we have a tendency to teach too much current events at times in our classes. And so we don't give students to the broader brush of what the overall aspect is. I certainly saw this with my college students, that particularly coming out of the financial crisis of 2007, 2009, we really saw them, they didn't know a lot about monetary policy beyond what QE was, what quantitative easing was. I think one of the really good ways to think about interest rates, or to look at them in terms of forecasts, is to go out to the Federal Open Market Committee's projections for the federal funds rate. So they make a projection of what they think that's going to be. And then, you add a certain level above that for what the mortgage rate would be. So the federal funds rate, if you think of it being the lowest of the interest rates within our economy, and credit card rates probably at the highest, somewhere above the federal funds rate is going to be the mortgage rate. And I think talking about historic rates and looking at graphs of historic rates can be very valuable. But the idea that we're going to get back to record low levels again, I think, is unlikely, unless there's, again, some significant market change that we're not foreseeing. But I think that, the expectation would be that you would be some level north of whatever the projection is of the Federal Open Market Committee, but certainly not at the levels that we saw in the early, in the mid 1980s, for instance.
So no more trying to still convince kids to put all their money in, CDs and savings accounts and grow really fast. Temper it from both directions, I think, is what I'm hearing, but talk about the long term. Well, thank you again. I really appreciate it. It's always a pleasure to have you join us. And I know that our participants welcome, and I certainly welcome your expertise and value it greatly.
Thanks for having me.
You're welcome. So last but not least, just a quick reminder again, those 2 webinars coming up. If you haven't already registered, please snag that QR code or grab the link from the chat and join us for one or both of those last 2 opportunities. We also have our virtual workshop I mentioned earlier, and the 2 book studies.